Yeah, ladies and gentlemen, as always, Patrick and Andrew organized a panel discussion, and honestly, I'm really happy that we have such a fantastic lineup here with three fantastic CEOs, three great companies. And I want to like to start with Amar Al-Jundi, President and CEO of Agnico Eagle Mines. Amar, come to the stage, please. Where are you? There you are. Agnico Eagle is a senior gold mining company and the third largest gold producer, now by market cap, the second largest gold producer in the world, producing precious metals from operations in Canada and Australia. Please have a seat there. Thank you very much. Finland and also in Mexico, they have a pipeline of high quality exploration and also development projects in these countries, as well in the USA. Agnico Eagle is a partner of choice within the mining industry, recognized globally for its leading environmental, social, and governance practices. I think also for profitability. The company was founded in 1957 and has consistently created value for its shareholders, declaring a cash dividend every year since 1983. That's exactly what you want to have. Fantastic. Thank you very much for that. The second company is Triple Flag Precious Metals, and Sean Usmar, the founder and CEO, will be here with us. Sean, please come to the stage. Very warm welcome. Hi. Thank you. Please have a seat in the middle. Thank you. Triple Flag Precious Metals is a pure play precious metals focused royalty and streaming company, which was founded in 2016 and went public in 2021. Their mission is to be a preferred funding partner to mining companies throughout the commodity cycle by providing customized streaming and royalty financing while offering value beyond capital as partners via their networks, capabilities, and sustainability support. Last but not least, another fantastic producer, Alamos Gold, and please welcome John McCluskey, the President and CEO. Welcome. You can also use the stair. Thank you, John. Yeah, mind the stair. Great. Good to see you. Please have a seat. Thank you. Alamos Gold is a diversified gold producer with a long-term track record of creating value for all stakeholders through solid financial performance, low-cost production growth, and a company-wide commitment to social responsibility and environmental stewardship. The company was formed in 2003 through the merger of Alamos Minerals and National Gold, which shaped the success driven by a good work culture and strong values. So, let's get started here. So let's sort that out. As you see, the hotel is that poor that I have a hand micro. So, well, all right, guys. We have some questions to all three of you. It would be great if you can answer that in the order if you like. And also some, questions, of course, directing to your companies. First of all, I would like to know the gold price has consistently strengthened over the past 16 months, whilst equities have not responded to most of this up move until very recently. I mean, we saw that the last 2-3 weeks was very good, and a lot of also your share prices went really up. Can you share your thoughts on this and why investors seem somewhat still skeptical? Maybe, Amar, you want to start?
Sure, and thank you for the question. We get asked that a lot, and our answer is always the same. I think what happened is about a year and a half ago, when gold went from about $1,600 to $1,900, it was a time of very high inflation for everybody, including the mining industry. So what you saw broadly in the industry is the gold price went up, but margins didn't. And a lot of people were disappointed. They said, look, I called it right. You know, I've invested in gold, gold went up, you're not making any more money, the share price hasn't moved, and they were disappointed. What I can tell you, though, is this move from 1900 to 2350, we're capturing all of it. We don't have the same inflationary pressures, and I think what the market is going to see when the companies come out with their results is that we've made a lot of money, and I think when people see that we've made a lot of money, the share price will follow.
Okay. John, your view?
Yeah, look, I think to add to that, Look, mining is challenging when things are easy, and we've been through a pandemic. There's a lot of challenges on the horizon, but you are seeing the sector, to Amar's point, starting to deliver. But I think there's a sentiment lag, and I think you're also seeing a bifurcation. John Reed is in the audience, and he'll talk later, so I'm going to not trip over the many more thoughtful things he'll share. But it's quite clear that there's a fundamental demand through central banks and others driving physical demand and pricing. The equities just aren't seeing it, and we haven't been successful yet in getting the generalist capital en masse to see the fundamentals and actually to catch up to that. It's almost been a magnificent seven risk-on environment, and I think that hopefully we'll see that catch up and that change fairly soon.
Yeah, we need only, let's say, 2% out of the magnificent seven, and we have a big party in all the gold equities.
Absolutely.
That's for sure. John, what's your...
I sort of reiterate that one of the biggest headwinds, I would have to say, is just looking at the S&P 500 over the last 4 or 5 years. It's just been on a tear, and on a comparative basis, the gold mining industry has just sort of trundled along, despite the fact that the gold price has been rising. Gold prices is generally where people start to look during times of heightened risk, and clearly there's been we're at record highs for things like the S&P, for the Dow. That doesn't appear very much like heightened risk. So really what it takes is that first wave of investors, the ones who are not typically waiting around to be told where to put their money. It's those very sensitive ones that seem to spot first that they ought to be hedging their bets, taking some profits on those very rapid runs in the broader markets, and being more conscious of some of the other elements of what's going on in the economy. And two things that are now coming to the fore are the level of U.S. debt. That's the big one, and we see the spending just going up ever higher. There doesn't seem to be any sort of rationality to that at all. There's no interest in curbing that. And so between the debt on the one side and the inflation on the other, it's starting to set off a few alarm bells. And as that happens, people have been turning to gold. And at the same time that's beginning, say, in the Western market, the East and I would say the group of countries that have all essentially coalesced around the idea of gold-backed currencies as a counterpoint to the dollar. I would say that combination of things has been driving gold, but not necessarily gold equities. And gold equities are only now beginning to respond as we see the gold price going to record highs.
Okay, you just pointed it. All of you three said it with, on the one hand, inflation, but on the other hand, you said the debt situation, especially of the U.S. And we know this year the U.S. have to refinance $8 trillion. That's a really large amount. Do you think those 8 trillions could be a competition for gold? Whoever wants to answer.
No, I don't. I think it's. The U.S. can print as much money as they want, and they will get people to buy it. But if you look at the numbers, put things into perspective, $34 trillion in federal debt. If you add municipal and state, it's about $40 trillion. Mm-hmm. You can go on Google and look up in the U.S. because it's easy to get the data. There's about 80 million tax-paying families. That's $400,000 per tax-paying family. $400,000 per tax-paying family. There is no way on earth they're going to pay that. And really the only way to deal with it is to inflate your way out of it. So if they refinance $8 trillion, sure, maybe interest rates will be a little bit higher. They'll get it. But in the long run, the average family in the United States, if you squeeze them, maybe you get $5,000 a year. You're not going to get $400,000.
Definitely not. Yeah. Another opinion?
I almost look at the situation in the opposite sense. I think, if anything, they're not creating competition; they're creating an impetus for people to look at gold and to seek out safe havens. But The problem is, gold has just moved to a level now where it seems to be well beyond the reach of the average, say, U.S. wage earner. There was a time not that long ago when I was starting this company back in 2003, gold was less than $300 per ounce. Anybody could have afforded an ounce of gold at that point in time, right? And today at $2,300 an ounce. Well, if you could buy 1 ounce of gold, that's already a lot of money. You were saying $5,000 is a lot to squeeze out of a taxpayer. Well, $5,000 in discretionary income, that's an awful lot of money. So who is buying the gold outside of central banks? It's going to be wealthy people. It's going to be
maybe China.
I'm saying outside of the central banks. China has been one of the main drivers of in the gold market and has probably taken over price discovery by now. But outside of that, I'm saying who in the West is going to respond first? It's not going to be the man in the street. By the time the man in the street sort of wakes up and realizes that the currency in his hand is rapidly losing its value, it's been slowly losing its value, but it's going to lose it much more quickly as time goes on here, and there'll be no place for him to go. And that's always been the case.
Yeah, definitely.
Yeah, I think to John's point, I think the year I was born, gold was in the 30s, $30 an ounce. So in my lifetime, you look at how far it's moved so far. And fiat currency, at the end of the day, is a function of trust and confidence. I think we're seeing a third of the world's population looking for an alternative, either with the weaponization of the dollar or what's happened fairly recently. And I think that alone, plus continuing to print money in an unsustainable way, has to be a positive catalyst for gold. The trend is clear, and I don't think the secular trend that we're seeing is in any way conducive to a point where that's going to reverse. So I think the fundamentals look really strong.
Yeah, super. I see it the same way. In the absence of larger money flows into mining equities, which we really did not see, I think we just had a little start with what we've seen the last, let's call it 4 to 8 weeks. Many companies have been performing well and managed to reduce debt consistently, as well as implement share buybacks and or dividend payments. Which tools have you guys used in the recent years, and which ones are you maybe considering going forward? We know you are paying dividends since 1983.
Well, we start every year. The first thing in our budget is set money aside for the dividend. We pay $800 million a year in dividends. What's happening now as we're generating excess cash, we are reinvesting into the business, but we're generating additional excess cash. We have a normal course issuer bid. We have some short-term debt that we might pay off. So really, it's a combination of things, but set a good dividend that you never have to cut, and then there are other ways to return capital, and we are looking at that.
Look, in our case, I've been in the mining industry all my career in big companies, but this company was started 8 years ago this month with 1 employee and no assets. And so the best use of our capital has been through investment. But similar to Amar, I don't compete with Alamos and Agnico. A lot of our assets are linked to base metal mines where we're streaming non-core byproducts. The bulk of our capital that we're deploying is actually in producing assets with good reserve replacement cadences where we can offer a competitive cost of capital to those businesses. So you have this flywheel of cash flow that we can then continue to reinvest over time. So what that means for us is, firstly, the dividend. Our trailing cash run rate is about $160 million US a year. Clearly, prices are better. We're continuing to grow. We've grown 20% year on year for 7 years. But the big thing for us in that is dividend only consumes just over $40 million a year. We have practically no debt and a lot of opportunity to continue to grow. Even if we don't invest over the next 5 years, we've got substantial growth that's embedded in the portfolio.
Fantastic. That's wisely investing. John, we discussed it already in the interview today.
Exactly. Yeah. Well, we've been paying a dividend since 2010. As we started the company in 2003. Effectively, that was the year we took control of the Mulatos project through an option purchase agreement off of one of the major mining companies, and they had not been able to move that that project forward in 8 years. We got a hold of it, and 2 years later, we were pouring our first gold bar. And when I took it over, it had no permits. It had no deal with the local community. It had no water rights. We had no employees, and we had no money. And 2 years later, we'd built the mine for roughly $75 million. We had 450 employees, and we produced 95,000 ounces of gold in our first year. It took us until gold prices were a lot lower then. You know, gold was around $450 an ounce when we started production. But by roughly 2008, we'd paid back all the capital that we'd raised to build the mine. And by 2010, we declared our first dividend, and we've been paying one consistently ever since. So we gave back more money to shareholders through that dividend than we ever raised out of the market to get the company started. By far, we probably twice the money that we initially raised. But by and large, you know, we're not trying to compete with high yield stocks. We're a growth company. You know, we're not trying to compete with Barrick or Newmont. And if you look at their relative performance, they haven't done anywhere close to as well as we have in terms of share price performance. And why is that? Because we've gone against the grain. While everybody thought the name of the game was cash flow, we didn't buy it. We knew the name of the game was growth. And we've been investing heavily in growth. In 2014, just to put it into perspective, we were producing from one gold mine, and we were producing at about 145,000 ounces a year. Today, we produce from 3 mines. Very shortly, it'll be 4 mines. And we produce, well, last year was 529,000 ounces of gold. We broke over $1 billion US in annual revenue, and we made $250 million in free cash flow. I mean, that's the name of the game. That's what growth is all about. And, you know, I was telling you earlier that I was looking at an article that dated back to 2012. I was looking for press on the gold space because there's so little of it. I don't know why the press does not cover this story, because it's such an exciting and a very vital one. And if you look back in 2012, Barrick had a $47 billion market cap. We had about a $1 billion market cap. Today we're $8 billion, and Barrick is what, maybe 35, something like that. They're not what they were. So I think that's the reason why Canada is such an important stock exchange. Even though in the grand scheme of things, we're only 3% of all the equities in the world, in the mining sector, we have a habit of producing these little powerhouse companies that come out of nowhere. And I remember when Barrick was one of those. In the early 80s, when I started in the mining business, Barrick was a startup. And in no time at all, it became a major mining company. But, you know, every company, so every dog has its day, so to speak. And, you know, we're in that very steep growth trajectory that I think makes it a very compelling story for investors. You know, you can go out and buy an ounce of gold right now, and it's going to cost you $2,350. I'm finding an ounce of gold at the average cost of $13 an ounce. Nice and I'm deal, finding millions of them. So, you know, that's what makes it interesting.
Absolutely. Have you more recently seen a shift in the interest from specialists to generalists, maybe even from an older to a younger generation in your shareholder base? Has that started already? Because what I found this year and also last year when we have been, for example, at big fairs, all of a sudden we had a much younger audience. That was really interesting, mainly coming from Bitcoin. People made a lot of money and they said, oh, I want to deploy it into mining because I think it's the last resort of undervalued companies, or let's say undervalued value in that sense. Everything is so overvalued.
We are seeing more generalist investors coming in and very big funds coming in. And they, the generalist investor can invest in anything they want. They can invest in pharmaceutical, they can invest in tech. But they understand the role that gold has to play. And I will tell the audience, I've been doing this for 25 years. And in the last 6 months in particular, a lot of very, very big generalist funds are asking more questions about gold. And I would say the driver behind that is that they're nervous. They're nervous about the market. We've had a very strong run. They're nervous about elections. They're nervous about the US dollar. They're nervous about Russia. They're nervous about China. There's a lot going on. The market, the equity market's peaking out. They're getting worried, and they're looking at gold to hedge it. Since 1929, there have been 15 market corrections in the equity space, 15 since 1929. The average correction is 35% down. In 14 of those 15 corrections, gold outperformed by an average of 45%. So these people are smart. Again, it's not because they are necessarily gold bugs, but they appreciate that gold is a good hedge, and they're getting nervous about the market. And I think that's, everybody talks about China buying. I actually think some of them are now buying as well.
John?
My company was born out of Generalist Capital out of New York as a private business from Elliott Management. So they're about 65 billion AUM. They are not precious metals or even resource investors. They're multi-strategy with an evergreen time horizon and pool of capital. And when we IPO'd on the TSX a few years ago, a lot of those pools of capital from the Qataris to others were more generalist in nature. I know they're in the audience, but like the BMO conference this year was the busiest agenda we'd seen, and a lot of those groups were generalist in nature. As for younger, I must say when I sit in the audience and I look around, it isn't the most diverse, and it isn't necessarily the youngest. I think that's a challenge for the sector, candidly.
Absolutely.
We have to draw new talent. We have to draw a new generation of investor to the space. We have to make the case more compelling. We have to also understand the actual societal good that, businesses like that on either side, and ours can play for frontier communities. Like, it's not just about paying taxes. Like, the social good that actually good mining does for society is underappreciated. So we've got occasional journalist investors. There's some kid in Texas comes and visits us. He watches all our stuff on YouTube. He can even copy some of our guys' accents. It's a little strange. We're seeing a few of those starting to come in, but I think it's only the tip of the iceberg. There's so much more to do to attract that capital.
Okay. John, how do you see that?
I would agree.
You agree?
Wholeheartedly. Okay. I don't think there's much of a generational phenomenon, certainly not from what I've seen. But there is a very clear sort of change in terms of the more generalist-focused investors coming into the sector. And, it's interesting you'd have us three on your panel. We're probably, three of maybe the 5 names that the generalist investors are buying right now. And why is that? Well, you mentioned how the share price has been underperforming. Well, I haven't seen Agnico stock underperforming, and I haven't seen Triple Flag underperforming, and mine hasn't underperformed either. We've been 3 companies that have succeeded very, very well. The thing is, it's not like we sort of hit a peak and it's downhill from that. No, we're just sort of ahead of the pack, and we're about to jump ahead even further yet. And that has a lot to do with the strategies that these companies have pursued. And it's very much a value-focused strategy. And it's the one that really resonates with the generalist investors. We run our mining companies like real businesses. And
you're entrepreneurs.
Yeah, well,
That's
I'm the founder
difference.
of the company. You're the founder of the company. I mean, it's not that common these days that mining companies of this size are run by the founders. But we're largely driven by a certain entrepreneurial DNA, and you find really the same thing at Agnico. I mean, Sean essentially took over a relatively small company and turned it into a major, but that entrepreneurial DNA is still very much a driver of the business. And that really is the difference. I'm not just interested in building a big mining company. In fact, I'm not really interested in building I'm interested in building a high quality mining company.
And profitable.
Yeah.
And when I speak about that idea to an investor, call him what you will, that is the message they want to hear.
Yeah. Maybe a short answer from you guys. I read today that Stanley Druckenmiller, one of the largest hedge funds in the world, they control, I think, $65 billion in one fund. They started to sell the Magnificent Seven, and now they invest into mining. What's your view on that? Warning sign or smart move?
No, it's interesting. Just an observation with, I had 14, 15 meetings today, and I'd say a reasonable subset of those were moving into just defensive and physical asset classes because they have lost trust in either the financial system or elsewhere. And for some of them, they had mentioned that they had been engaging in that for some years now. So I think, to John's point, once everybody's found religion, it's probably a bit late, but I think it's a definite trend starting.
This is then the case when I start to wear the red pants.
Yes.
Okay, super. Okay, let's dive into the companies. Amar, I have a specific question for you. You have some big developments going on with a second shaft at Malartic, East Goldie and Hope Bay in the far north of Canada, shaping up, but also here in Europe with your Kittilä mine. Can you tell us a bit more about the exciting potential, please?
Well, we are, blessed with a number of mines that have long life, and really, we have 11 mines. It's almost the opposite. Which ones aren't growing? So we have Hope Bay, which is a very large land package that we think will be the next 400,000 ounce a year producer in Nunavut. We have Amaruq, which we have extended the mine life. We have Meliadine that we're expanding. We have Detour, which is with Malartic, one of the 2 biggest mines in Canada, and one of the 10 biggest mines in the world. It's expanding we're working on expanding it from 700,000 ounces a year to potentially over 1 million ounces a year. This is a mine that's been around since the 80s. Malartic, the biggest mine in Canada, going from the biggest open pit to the biggest underground mine. We're looking at a second shaft. That's a mine that's been around since 1923. Those 2 mines alone, we've found 35 million ounces in the last 8 years. So it just shows you the potential of being in a good region. Kittilä, we're looking to expand, and Fosterville, we're looking to expand as well. So a lot of growth, but more importantly, at least from our perspective, growth in safe jurisdictions and leveraging off existing capital.
Okay, super. John McCluskey, you reached record production, as you said already, of 529,000 ounces in 2023 with very disciplined all-in costs. What can we expect going forward in terms of growth and costs?
Well, you're well aware, we spoke about it earlier today, that we've just completed an acquisition, or we're in the process of completing an acquisition of our neighbor at Island Gold, a company called Argonaut. On a combined basis, that turns this Island Gold complex into 11.5 million ounce camp. And if there's one thing that's going to differentiate us from the rest of the peer group, let's say, within the mid-tier category, it's having a tier 1 asset like that. It's not just that it immediately hits 11.5 million ounces, it's the tremendous growth that's happening. So we have on the one side of the fence roughly 5 million ounces of low-grade open pit material to mine, and on the other side we have the very high-grade 11-gram Island Gold deposit, which since we've acquired it, we've mined out well over 1 million ounces of gold, and we've seen reserves and resources grow from less than 2 million ounces to over 6, and it's still on a very steep growth curve. So it's been really one of the most exciting gold discovery stories taking place in the market in the last few years, and probably for the most part because it was so unexpected. As you may recall, when we acquired that mine, by and large the market gave it a thumbs down, red raspberry, whatever you want to call it, but our share price lost 40% in the year after we made that acquisition. And we paid $600 million for it. And to put that in perspective, the market consensus valuation on that asset now is closer to $3 billion.
Nice.
So we've really sort of transformed investor perception with respect to value creation through M&A. We've got one of the biggest exploration budgets of any of the juniors or mid-tier companies in the sector. We're spending $62 million this year. We've been finding ounces at an average rate of $13 per ounce. That's been our cost for finding ounces. And we've literally added 5 million ounces in the last few years through the drill bit alone. So, this kind of value creation is what I think really resonates with investors. You know, if you're sitting there asking yourself, well, why should I buy a gold equity? Why don't I just go out and buy an ounce of gold? Well, it's because there are certain companies out there, and I would say, you know, the two producers sitting on this stage, Agnico and Alamos, have been among a very, very select group of companies that have actually been growing reserves and growing them at a cost through both M&A and through drilling, but growing them at a cost that an ETF just cannot match. So this is real value creation. And we spoke of this earlier. You know, the market isn't really paying for reserves right now, which is very peculiar, because that's where the value truly lies. And that is changing. I mean, it's literally changing as we're having this conversation. And the companies that have been focused on that reserve growth, those are the ones that are going to win as this cycle continues to move forward. And that's why I would say, you know, our stocks have all been doing very well. You're doing very well by the virtue of the fact you own a royalty on one of our big producing assets. So, you know, that's a great proxy for the strategy, if you will. But you know, the companies that make up the sector, I think all of them are going to benefit. You could practically pick a winner with a dart now. I mean, the market's sort of moving in that direction. But the companies that have been leading through the downturn, and these are three of them, there are more, but these are three of them for sure, those companies are going to continue to lead, in my view, for those very reasons, for the focus on value creation.
Yeah, absolutely. Sean, to you. The royalty streaming business works a bit different than mining, as you don't have direct operational exposure, of course, which could be also a big benefit. Can you give a short insight to the audience on the mechanism and how this relates to the current gold price? Also, there are connections between you and the panelists' assets.
Yeah, so, I mean, firstly, you know, our strategy, I'm very grateful to have a royalty on Young-Davidson. It's a beautiful asset in John's portfolio. Hope Bay, which Amar just mentioned earlier, and we're very excited to hear actually what he just said, as well as Fosterville, which I got to see as well last year. But our core strategy is really more not about accumulating other people's royalties. We've done that through portfolio acquisitions and that occasionally, but it's really, I think the risk allocation and capital allocation model in the mining sector has been impeded because the conventional forms of funding through equity capital markets and that are not working. They're working, I think, well for companies that have executed well, like the two gentlemen on the stage, but for many, the risk capital hasn't been available. So what that has meant for us is, you know, I was in Billiton, BHP Billiton, Xstrata. These are base metal businesses that often produce gold or silver as byproducts. A copper mine, like we have North Parkes in Australia, that's 25% of our NAV. It's been operating for 35 years. In 2000, it had 1 million ounces of gold in reserve. They took 1.1 million ounces out mined over the next 20 years, and they have just under 1 million ounces of reserve. And the operators think it'll go on for 100 years. You don't find mines. And just this quarter, that is producing 90% more ounces from that mine for us than it did just a quarter ago. So when you think about growth, and you think about execution, that is great. And I'm not taking a core part of that operator's focus. As a previous base metal miner, it's not strategic. I can offer them a far better cost of capital. Those dollars are only worth 4 or 5 times EBITDA multiples, typically, to those businesses, at least historically. We invest in their social programs to enhance their privilege to operate with their communities, scholarship programs and things of that nature. So we're part of the ecosystem. And to your point, what it makes this helpful, and it's almost the gateway drug to think of generalist investors. A lot of them don't care about grades and tons. That's a level of specialist knowledge that, like my founding capital provider, they just want to know that they've got a managed portfolio with a team that knows how to source deal flow, execute and structure good deals, and can build a balanced portfolio of growth with high cash yields. So 90% cash margins, 234 assets, 32 assets that are producing cash, a 20% year-on-year growth rate over the last 7 years, and a decent dividend with practically no debt on the balance sheet. That's really what that... And during inflation, really, it's top-line exposure. So we are getting exposure to physical ounces that is multiplied by gold price, and that math is easy. So 76% gold, we're 20% silver. I know we've got some silver fans at our table at least, and I enjoyed your speech. But those are just precious, simple, diversified, high margin exposure to investors. That's what it offers.
Okay, super.
And it relies on good partnerships.
That's really important for business, always. Well, Amar, Agnico is known to make successful investments into smaller upcoming companies. End of the year, you got more attention than usual for your investment into a nickel company. I think it was Canada Nickel, right? Shall we expect a more diversified approach going forward, or was this just an opportunity in another metal than gold? Because honestly, I was really happy that you invested there.
Well, our strategy is a little different than many of our peers in that we don't aspire to be operating everywhere in the world. We focus on certain regions that we like, and so clearly, Canada is one of the regions we like. We produce more gold in Canada than the next 8 companies combined. Our revenue is 98% gold. We're a gold company, but we do have a good capability in mining in the regions that we mine, and this nickel company is a small company. It's a very large, very low grade nickel deposit, but frankly it's a huge option on the price of nickel with a team that we know in our backyard.
Absolutely. Well, I fully understand the investment because I also think it's a really great property. John, it is very timely to have you on the panel tonight. You've just announced 2 weeks ago, and you said it already, the acquisition of Argonaut Gold, and we spoke about this today already. Can you give us maybe a little bit more ideas about the synergies? I mean, why you have done it? It makes absolutely sense because you are neighbors, and I could imagine to lift the synergies alone probably pays for the whole deal, right?
It's the case, and it's really that we saw something that some observers have told me they have not seen in 40 years in the mining business, and that is where an acquiring company, they see their shares rise on the announcement of an acquisition at the same time as the shares of the acquired company rise. So the day we announced this deal, Alamos shares went up 7%. It was remarkable. In contrast of when we acquired Island Gold back in 2017, our stock went down 16%. And that just goes to show you, the market has its time, and at this point, there is a real focus on gold. The day we announced the acquisition, it happened to be the day gold broke out. That helped a lot. But just given the fact that there are, in excess of $500 million in synergies, and I'm talking about real measurable synergies, against a $500 million enterprise value. We paid roughly just over $300 million for the equity, and then there was roughly just over $200 million in debt. So on a combined basis, we've more or less paid to acquire the company effectively what we've been able to generate in synergies.
And so it pays for itself.
Well, when you consider you've got a 5 million ounce gold deposit and $1 billion worth of infrastructure, in some respects it's more than paid for itself. But there's so much sense on both sides of that equation. There's no doubt in my mind that Argonaut shareholders are going to benefit tremendously by being part of this bigger story. And I was mentioning earlier, on a combined basis now, we've created a tier 1 asset in that belt. We've tied up all the ground for effectively nearly 100 kilometers of strike along this mineralized system. And the heart of it is the 2 deposits, which make up 11.5 million ounces. But the potential for growth is really significant. And I think that whole idea has really captured the market's attention. And it's not just, it's been a great thing for us, obviously. It was a great acquisition. But I think it's also a catalyst for the mining space in general. Like there's been a number of very high-profile acquisitions. Agnico Eagle has been very active. Newmont has been very active. There's been some smaller deals coming along. But the fact that this much smaller deal has been announced, but in conjunction with this very, very rapidly rising gold price that's been moving very quickly in the last 8 weeks, that has really focused the market's attention on the value that can be created through M&A. And as investors spend more time looking at that very subject, they're going to find that in contrast to the deals that were done over a decade ago, the deals that have been done lately are really quite valuable in that they're literally creating shareholder value through the acquisitions.
Yeah. Okay, super. Last question, Sean, to you. How has your, well, we couldn't say really production, but let's call it your profile, evolved since the inception of the company, and what can we expect going forward? And I think you said it already, you are receiving also physical ounces. What are you doing with them?
Yeah,
I'm sure you don't store them in your own vault, right?
No, it's funny. We've had investors at times say, you want to differentiate yourself, just stick those ounces away somewhere, and it'll be worth more in the future. And I don't necessarily disagree with the sentiment, but I think what makes this model work really well, so going back to your point, we started in 2016, our first deal closed, so it was end of April 2016. I closed my first deal on a mine called Cerro Lindo, $250 million in December of that same year. So that first year in 17, we did 33,000 ounces with 90% cash margins that year. We then have, and through last year, have had a 20% ounce growth rate, physical ounce growth rate. And this year, I think we're the only in the intermediate and senior space to actually show additional growth with our guidance. And then the 5-year average beyond that is further growth to 140,000 plus ounces without investing another dollar. And then, of course, there's 2 decades of portfolio duration and the potential to invest a lot more there. So someone asked me today, what do I think the next 5 years will look like? Well, 5 years ago, we were only producing 30-odd thousand ounces. And, I'd like to think we've nearly tripled the business in that time. I would expect us to at least be able to double it or do better over this period because the market needs this capital. There's groups that have access to capital because they execute well. But for most, the valuations are under pressure. Equity is super dilutive. Debt is far more expensive. And I do believe that a lot of the growth that this world needs, whether it's in copper or elsewhere, is not going to necessarily come from the majors. I think we've seen a lot of companies that we've invested in as part of the capital stack go through change of control, just 3 or 4 in this last year, and be acquired by more senior operators who then in turn, they don't provide the risk capital necessarily. If they do it in a very disciplined way. Our focus is on providing that capital allocation and then being able to benefit and generate growth over time. So that's the expectation. More capital, more cash to reinvest, more dividends, more growth.
Okay, super. More dividends, more growth. That is fantastic. Thank you very much for that. I only want to have from each of you one number. Where is gold Christmas this year? Just a number, please. No explanation. Just, you have 5 seconds to think. What is your feeling?
2,600.
2,800.
I was going to say
2,800.
2,800?
I was going to say 2,650.
Okay, well, that's a thing. Fantastic. Thank you very much.
Thank you.
So, stop. Q&A. There are questions probably. Yeah, Patrick, I'm sure there might be some questions. I'm sure Pascal has a question. Because here's also, Patrick, there's a gentleman here in the front.
Very simple question.
1 second, wait for the microphone, please.
Simple question. Good evening. Thank you. That was excellent. Is the correlation between Bitcoin and gold just purely accidental, or is there some trend towards this?
Well, I mean, personally, I think that I'm a glass half full kind of person. I think that what Bitcoin is doing is bringing an entire generation of young people to the question of fiat currency and do they really trust it? And it is inevitable, in my opinion, that these younger generation who's asking that question ends up saying, well, actually, the best thing is probably gold. So again, different people might have a different view. I actually think Bitcoin is going to help the gold business.
Yeah, look, I think just to add to that, I think we got empirical data not that long ago where the minute the world became scary, Bitcoin didn't fare so well, whereas gold actually held up rather well. So those correlations are fine when the world is more sane. But I think when gold is at its best and the reason you have it in your portfolio is perhaps the time when that breaks down.
I mean, to me, the whole affectation of Bitcoin, the fact they named it Bitcoin, I never saw an article for 2 or 3 consecutive years that I was reading stories about Bitcoin on the web where they didn't show a gold coin. And the whole point is there's no coin. You know, they've borrowed. How do you get a gold coin? Well, you mine the coin, right? I mean, this is not an accident that they've kind of modeled all their nomenclature and their whole sort of vision of what's involved on gold mining business. But in point of fact, you can't tell me that a string of code is not a proxy. It is. There's no coin. You're buying a string of code. And I've talked to people that would never touch a share of a gold mining company. People that I knew growing up that never invested in equities, and they own Bitcoin. And I said, what are you planning on doing with your Bitcoin? They actually thought there was a physical coin.
Yeah.
I mean,
it's not, definitely not.
So the reality is that gold is, you know, that's fundamentally something real. That's an element. The only place that gold can be created is a star, and that's it. A star goes supernova, after which all the heavy elements are produced, and that's how gold's produced. Mm-hmm. And what arrived on the planet during that period of planet formation, that's all the gold we have, and that's all the gold we'll ever have. How many cryptocurrencies have been created up till now?
10,000 easily.
Essentially another form of proxy, if you ask me, and it's not a store of fundamental value.
Definitely. Pascal? Yeah.
Amar was talking about margin, and my question to all of you three is, which input costs can or do you hedge? Might be oil or FX or whatever.
I'm sorry, that wasn't very clear.
Which input costs do you hedge?
Which input costs
margins.
Do you hedge, and to which extent? And
I like diesel, for example.
Yeah,
like
for example.
We hedge the Canadian dollar because a lot of our costs are labor, which are in Canadian dollars. So we hedge that. We hedge diesel. I'd say right now we're probably 2/3 hedged on the Canadian dollar at a rate that's better than our budget, and we're probably about 40% hedged on diesel.
Okay, thank you. One more question, Patrick?
Oh, sorry, I think he wants to... Yeah.
Sorry?
Hello, yeah, quick question.
He wants to hear from the two of us.
Ah, okay.
Look, I have different considerations. I just have the top line exposure. Our challenge is more investing in mines in the first place that have the margins to be able to withstand that and that manage those operations well, because I want partners who can successfully explore and extend their mine lives, and we can be part of that journey where we provide the upfront risk capital. So we spend a lot of time actually looking and modeling at distressed points in the cycle and individual years of cash flow for that reason. So it's more stochastic modeling that we'll look at in order to avoid that, but no hedging.
Yeah, similarly, we hedge the dollar, we hedge the Mexican peso, and we also hedge diesel. We do a modest amount of gold hedging, but they're all zero cost collars, and they're effectively all closed out quarter by quarter and then by the end of the fiscal year. So we don't have any long-term hedges. It's more of a sales management. And as a result, we've consistently beat the London fix in any given quarter. And that's about all that hedge program is used for. And that would be the full extent of it.
Okay. One more, you said? Or
one more question, yeah, just to actually bring it back more or less to the blockchain discussion. HSBC just recently issued an asset-backed token, actually gold-backed token, and I wondered if, and some analysis has actually shown that there's not so many ounces behind these tokens, and I just wondered if any of you had a strategy perhaps to expand your balance sheets by offering tokens in addition to the shares you wonderfully offer.
Who wants to answer?
Yeah. So firstly, I suspect that might be a John Reed question in his segment.
Yeah, definitely.
The Gold Council.
That's something for John Reed.
Yeah, but also we were approached 4 years ago, some guy down in, I don't know where, who had some blockchain technologies and wanted to have the physical backing actually linked to silver. But candidly, when we were starting to look at the breakdown of where the value was being created, we were essentially subsidizing his business model. So we decided not to do it.
Okay. Great. Then, thank you very much. Enjoy the dinner, and we will move on in approximately 15 to 20 minutes then with John Reed. Amar, Sean, John, thank you very much.
I have to shake your hand.
Great.
Thanks. Yeah, thanks.
Pleasure.